My name is Jeffery Potvin, or JP, and I am the one of the GPs in the Supporters Fund and operator of OPN.Ninja, an early stage angel VC group. But we want to thank everybody for joining us again. We're going to play a little bit of an intro video that will carry us through. Feel free in the chat section to post any questions, any comments, and we will jump in while we're going. The walkthrough is about 30 minutes to kind of go through the overview of the industry, the space, and everything that is going on in early stage investing. And then we'll open it up to questions near the end. So feel free to jump in at that time. But in the meantime, there is a chat section and you can post any questions that you may have along the way. And again, thank you everybody for joining us today. For joining us today. We're conducting a lunch and learn to help people better understand the asset class of early stage investing, but also to look at how and possible to become an angel investor and what that looks like. So at OPN, we're proud to be working in the community and being part of a larger Canadian ecosystem and global ecosystem for that matter that ties in early stage investing. And we wouldn't be here without our fantastic partners, and in no particular order, from Miller Thompson, Nemo Private Wealth, with the Fry Gang, Startup here Toronto, City of Toronto, System Bind on our hosting side, our accounting firm, our software company, Flow Water, and then of course all of our Founders Institute, Techstars, accelerators, and incubators who participate and bring a lot of value to what we do. So the problem is that companies really do struggle to access early stage growth capital, and it's being the most vital stage of any startup company is really being able to get those early dollars to help them grow. And angel investors are a vital path, or in the vital path to growth. And we utilize those angel investors when we're growing and successfully investing in companies. So a little bit about our team. We've been working on this over the better part of 5-6 years. And as we grow, we continue to bring in a lot of people that are really helping us work through the ecosystem, from our general partners, Jeff and our new general partner will be coming in the next month on the new round, all the way through to our Laura, who's our GM, and the rest of our support team that really help us flourish in this space. And we're bringing on a couple new board of advisors and directors to kind of round out our position. A little bit on background on myself, ex-software engineer, e-commerce manager at Loblaws. In the past, I guess that would have been 20 years ago, developed a software company that does resourcing for enterprise and early stage companies, and part of 7+ angel groups. We're part of screening committees, and we look for and help early stage companies get ready for funding. So being part of these screening groups and being part of this ecosystem has certainly allowed us to better understand the space, and utilizing that knowledge to share back to help early stage companies find their way through investment. Not all of the companies, but there are a bunch of companies here that myself has invested in over the years, and certainly can dive into those anytime to share the differences, but they're from prop tech, retail, CPG, gaming, deep tech, social, a lot of great spots, fintech. There's a lot of great areas that we tend to invest in and focus on. So in this early stage asset class, which is in the pre-seed and seed round investments, what we're excited about it is that there is high potential growth. It is high risk, one of the most high risk areas in any sort of asset class that you can invest in. But with high risk comes high rewards. You know, the typical yield for an angel group or angel investment is anywhere between 18 to 22%. And we try to fit into that upper side of those numbers. And of course, there's different returns that you'll see in the market that you can get from public returns on the stock market to jumping into VC returns that do get a lot more secure as you go upstream. But we tend to work with and enjoy the excitement of working at that really early stage. So there are multiple forms of investing that you can do at any stage, but specifically in the early stage investing, from crowdfunding, angel investing, venture capital, friends and family rounds, debt financing, a lot of great areas that you can focus on if you want to jump in and just start to get your feet wet in the investment arena. So as Laura mentioned, there's lots of different questions that have come up in the past and what we can interface with today. So, you know, one of the questions were, how do I become an angel? The first one was, how do you become an accredited investor? If I don't qualify, what are my options? Well, the first question, how do I become an accredited investor? It is a designation that has been put forth by the government, and there are different ways to qualify as an accredited investor. The most common is that you have an income that makes over $250,000 a year for 2 consecutive years, or that you have asset values that are worth more, I believe, than 1 million. And then there's different buckets all the way up, 1 million, 5 million, etc. So all of these are different ways to become accredited. And the reason they do this is because they want to ensure that the investors that are doing this aren't putting their life on the line and have a potential of losing all of their value in too bad investments. They do want to make sure that you're looking out for your well-being and that you're going to be able to invest and move forward. But again, as a accredited investor, this is to regulate a fund or regulate investments, but it doesn't prevent you from making investments into the other areas as previously discussed. Laura, did you want to jump in with a few other questions?
Sure. So with you, how did you start investing? When and why?
You know, I probably should have had taken the time to actually really plow through this to figure out when I made my first investment or what my first investment was. When that question came up, I've done so many things that I was trying to think of what was my first investment. And I've been investing in the public markets for quite a long time. Since you were first able to do it on the internet is when I jumped into that in my early 20s. And when I did jump into that early stage, I guess, internet marketing or internet investment side of open markets, that's where I learned about what a accredited investor was, what the markets invested in, how they invested, what numbers they were looking for. So I was self-taught. I don't think I ever slept, but I was working the markets overnight, preparing what trades I was going to make on the bell at the end of the day or at the morning. So I played the markets on the opening and ending bell. And I would literally just go through, do all my research. I knew the companies inside and out. I would call companies. I spent a lot of time and I think I didn't sleep because I was in school at the time, and I really just wanted to figure out and understand how the financials work, what they look for, what was missing, what could stand out from it. So I would do all of my research before, again, I would make any sort of investments. And I separated my portfolio into penny stocks and your blue chip stocks, and of course, more of the aggressive side as well. So that would go more into your tech-related stocks, etc. So in my early 20s, I would focus and diversify my time, which I guess really set the stage for my interest in these early stage companies, especially in the penny stock side of things, which penny stocks are usually companies that you would invest on that are in the venture exchange, making their way into the TSX. They're anywhere between a penny to 50 cents or $1. And you're just kind of working through to understand more where these companies are going to go. So I think that's kind of where I got my feet wet. And then from there, as I continued to progress and invest in different things in the public markets, started to look at when I could make my first real investment. And that came probably, the one that pops into my head was 15 years ago. We made an investment into an individual that was running and doing everything around baseball and rookies going into the draft year. So his name was Bob Elliott, and we put together a platform for him called the Canadian Baseball Network, and then he would run all of his draft information from there. So we helped build the product, then we became owners with them, and then we sold the property. I guess it would have been, feels like maybe 7-8 years ago. And it still runs today, and Bob is the sole owner of that, I believe. There may be another investor into it, but he builds out all of his anything and everything to do with baseball. So it's pretty exciting that we were able to be part of that. And I probably would guess that would be the first company that we really took a liking to and dove right into.
Awesome. And I didn't ask you this before, but who would be your mentor in all of this investment world?
It's a good question, because from a mentor standpoint, when it came to this, I self-taught myself everything around finance all the way through my corporate and business career. And of course, when it came to who I always looked at as being a mentor to me, I had a lot of mentors that I would spend time with throughout my career, especially early on. I found people that were mentors in areas that I didn't have strengths in. So as an example, when I first started in Loblaws, my first mentor was, I shouldn't say in areas that I didn't know anything about. My first mentor was Ben Alex, and he was a software engineer. So he became my first mentor. I learned a lot from him on the software side. But then after that, I went and got another mentor, which was an senior vice president of marketing, because I always felt that marketing was a huge initiative to what we do. So he became I went and asked him. I was just a junior developer at the time, and he was my marketing mentor. And then from there, I brought in a lawyer mentor, and I guess I just became more full-rounded on that side. But when it came to actually investing, I think my angle was that I just wanted to learn about everything, and self-taught myself in many areas and learn from a lot of other people. And that kind of helped me build thesis and build an understanding of the markets and what I was looking for and what I wanted out of them.
Cool. So why did you start OPN and the Supporters Fund?
Well, I think it came to two sides of the coin on this one. Is that when we were operating and running Hardboot Communications, our resourcing for enterprise software development and platform development, what we kind of were looking for was, what was our funnel, what was our angle in order to build out what we were currently working on. And from that, we started to look at all the things that we were doing and what we were, I guess, good at, or what we could focus on. And one of the areas that always stood out and popped out was that I always had an attraction to early stage companies, all the way from my time at Loblaws, where I brought in a lot of startups into the big business. I didn't realize it at the time, but it started to come out 6 years ago. And what brought that out was I spent a lot of time at Loblaws back in the day, working a lot of hours, coding, developing, building the platforms, building the channels that we were working in. And the front end admin had no idea what I did, but they knew that I was in this new digital age space. So any startup that would reach out to Loblaws front office admin, they would reach out to me to take on that call. And I guess I never turned down a challenge, and no one had designated this as my role, but I decided I would meet every single one of these startups. And it was everything from Google all the way across to every small, mid-sized enterprise that would come in through the door, and I would rip through their presentations and figure out how to help them, and then pitch them into the senior level executives if I saw it was a great fit. So I continued to do that throughout my time as being in Loblaws. And then from there, I continued to work with startups. And then about 15 years ago, I just started making those small little investments. And about 6 years ago, when we started OPN, this kind of comes full circle, but the outcome was that these startups that we started making investments in started asking us for how they could get in front of more angels and get more options in front of investors. And after a few times that this came up from companies that we started investing in, decided that there was a bigger opportunity here. And I think we faced a problem too, where we were getting tired of seeing startups getting beaten up and walking away from a build or walking away from what they were trying to accomplish. They just didn't have the understanding and dedication over the previous 10 years. So as we started to see this market change, we also started to see that there was a bigger opportunity for someone to come in and kind of help these startups work their way through the system. And we had, give or take 10 years of startup experience in working and building a company that we thought we had a lot to offer that we could bring and help these startups get in front of the right people. So we started to build up our networks around angel investors, VCs, and of course the startup space. And that's how we started to get our feet wet. And we joined a lot of the angel groups and started investing through them and started to kind of build up a brand and a value that showed that we were in this for the long haul and that we were going to help startups work their way through the ecosystem and build more jobs, build more great companies in Canada, but then obviously globally as well.
Great. So why don't we go through the deck again and talk about the landscape and the ecosystem and how we fit into it?
For sure. So the landscape in Canada is it's pretty interesting, and we're going to use the Canadian side of it versus jumping in globally. And within the Canadian ecosystem, the great thing is that there's a lot of support today than there was 5-10 years ago. And with over 118 accelerators and incubators across Canada, there's 44 angel groups, which is massive, probably double than it was even 5-10 years ago. There's about 252 investment banks, and we have over 5,000 startups a year that jump into this space. Not everybody's going to be investable. Not everybody's going to go on hockey stick growth. But the great thing is that 97% of Canada is made up of small, mid-sized enterprises, and that can vary from anywhere from 1 to 100 people. But the majority is 1 to 3 people in a company, and that's phenomenal. And that's what allows Canada to be such an innovative country. On a global ranking, we talk a lot about how strong the Canadian ecosystem is, or the Canadian ecosystem is, and it really has significantly changed, and it does compete heavily across the major markets. And if you look at what those major markets are for startup innovation, we rank in the ecosystem as a city number 24, but as a country, we're in 4th to the US, UK, and Israel. And what's really interesting about this is that OPN and Supporters Fund are our top 5 countries that we operate and have the most interactions with on a daily or weekly basis are US, UK, India, Israel, and Canada. So where does this total ecosystem fit, and how do we look into the world in the global side of things? Our major cities fit in quite well in the top 200 rankings. Toronto is 24th ranked, and we do have quite a supportive ecosystem, which I think speaks very well to where we are today and how we support companies as they move forward. So when COVID did strike and that started to be pushed through, a lot of Canadian innovation really jumped up and started to innovate and figure out ways to solve the problem within the COVID-19 space. And it was really significant on leadership on where we were going with the startups and how we could tackle the COVID problem. So I think the big thing that comes out of this is that regardless of how the year has turned out, investors really did there was a lot of challenges, but even in the global markets, but Canadians really did step up and continue to support and invest in the early stage companies, regardless of the change that occurred in capital. And you can see here that with the changes that occurred in the capital, that regardless of the drop that you'll see from Q4 to Q1, which was just over a year ago, it took a significant drop, but it started to make those increases. People started to get back into that comfort level and start to push forward, and seeing that there was light at the end of the tunnel, and there was a lot of great opportunities and deals that were coming through from dollars being invested back in a number of companies as well. So it's a well-supported funnel. There's certainly a lot of deals that get investment. Of the 5,000 companies that are new every year, as they start to work their way through that ecosystem, there is a good number, between 500 to 600 companies that are getting funded in a year, and they are bringing in some significant dollars overall. And health sciences, being one of them, has really started to make a big mark, especially with COVID and the changes, which means that you're getting a lot of change in the sectors, and that really makes a big difference in how we attack the global market from a life sciences or fintech or any of the other areas. Is that once we start to make those doors open up, the opportunities just increase everywhere. So just to kind of reiterate, you've got the startup funnel, and you can see that there's a lot of companies that come in, and then how does that work its way down to getting into larger public funding? And as I mentioned earlier, you're getting into that 400 to 600 company range, where some of those companies have to work their way through that pre-seed and seed. And due to the strapping of dollars, this is where there's a significant opportunity that more companies can get funded, with more angels being involved, more people opening up this asset class and making those investments, so that as they work their way down to the public markets, there can be a lot more of these less risk averse companies and VCs jumping in to make investments. From a founder standpoint, and the great thing is that this has significantly changed over the better part of 10 years, and hugely in the last 2 to 3 years, is that where you have how the founders are starting to structure. And the change is really that there is a lot more females that are jumping into the market and raising funds and pushing and building out their new companies. And it's fantastic, the growth that we've seen, and continue like this. And I suspect in the next 2 to 3 years, we'll be at that 50% threshold, which is phenomenal. And just to kind of point out that it's not that you're having less males building companies. What you're having is way more women getting into the ring and building great companies. And with that, it's leveling out. So you have a high threshold, and you're now just bringing the base up and getting that equal playing field, which is pretty amazing. So some of the reasons that startups fail, and why angel investing and coming in early is going to really help, is that a lot of the times it's not the full knowledge, back-end understanding, ways to maneuver in the space, but a lot of it's just running out of cash. It's a real big problem. And the biggest one, as you can see here, it's no market fit. And I think a lot of the times, a lot of startups, and we use the term that 95% of startups just want to build, and they forget that they need to get market fit. They forget that they need to get investors behind them, or to build sales. So I think a lot of angel investments that come in, they're really able to help clean that up and help these founders really understand the market better, and not just be builders, but figuring out how to get that MVP into market and have it tested by the right clientele. So taking funding by the numbers, you can see how significant angel investing can really be in this space, where you see personal funding being the highest amount of percentage of investings that are occurring. Is that even from an angel investor, we always look for that friends and family, personal funds that you're putting into growing your business. And we can shift a lot of that by really empowering more angel investors to make that leap and jump in and help out. And you can see that even crowdfunding, as it's been only around for a few years, that it's really making a big difference as well in this space. So we've built a different type of funnel that allows us to understand better the types of companies that we want to invest in. And if you look at seeing a couple thousand startup companies a year and funneling that down to 300 companies, give or take, and then only investing in 10, you can see that the size of funnel and what it takes to go through and what type of analysis you need to do in order to really dive into this space and understand what is going to make this company successful. And not only just from a founder standpoint, but is the company scalable? Are they able to maneuver quick and pivot when they need to? Are they psychotic and know the space better than anybody? All of those types of things really help. And of course, the data tells a different story as well. And some of the other things you can look at that really stand out, and I think we look at this as well, is that co-founders have a really big survival rate and they have a better success rate as well. Just as a founder who has come into the business and has run their second or third startup, they have a bigger opportunity for success because they've gone through the ringer and they've learned a lot. So it's not to say that first-time founders don't have the same success, but they may need a lot more hand-holding to get to that second round, third round, and then from there, that learning will help them succeed as well. But we do know that if there is a failure, that founder has a better chance of succeeding in their second or third business. And we have that with one of the companies we invested in, where he'll wholeheartedly tell you that in his first few businesses that he failed, but he learned so much that he was able to take a look at his next business and figure out what his success looked like from the beginning. So we kind of chatted to a bunch of different things that really share an overview of the category and what the opportunities are in this space. And I think if you look at just high level, some of the pieces that can really stand out in this early stage area is that it is high risk, but it's high reward. It's a real managed process, and you can really dive into figuring out how you can help a company versus when you're working with Apple, there's a pretty good chance you're not going to have that same opportunity to sway a business outside of buying their products. In this case, you can really help a business sway in the right direction based off, the value that you can bring to that early stage company. So there's a lot of return and upside potential, and that depends on how much you're willing to put into it from time, effort, and dollars. And diversification is significant. You can invest in funds, you can invest in single entities, but at the same time, you can go cross categories, across verticals. There's so many different ways that you can invest, which allows you to diversify a portion of your portfolio. And as I mentioned many times, investors are startup navigators. They really do help a company understand where they're at and where they're going. So there is a pretty significant process that we talked about a little earlier on, something to look at when you are making investments. But just on our end, when we have companies come in, and an angel group will go through the same, they'll receive a couple hundred applicants that will be applying for screening and being able to get into the investment arena. From there, they'll break down those applicants, run them through a screening team. That screening team will review the content, review what the startup's doing, have them pitch. And then from there, they'll break that down even further, down to 3 to 5 of those companies, prepare data rooms, and then from there, they'll get them in front of their investment groups. And through that whole process, you can see where you're lobbing off a good chunk of those companies that are then going to have to go other places to continue to build up the value in their business and build up opportunities to pitch for investment. So this is what mostly every angel group will go through. And you can see that just from taking 100 applicants down to 10, down to 5, you're looking at 5% as a number that you're going to be able to see out of each month that they're doing this. So where does Supporters Fund and where is our positioning into this space? Well, we kind of created our own little space where we want to help early stage companies get access to global investment community. And we've taken that by slotting ourselves in between the accelerators, the incubators, and all of the other groups that are in the market, government and non-government funded businesses that we can work with to take the best of the best and get them ready and pitch them in front of our global community. So our brand focus is that we showcase and support early stage companies across all verticals, and it is the funnel for our Supporters Fund investments. And the Supporters Fund, which is our investment vehicle, We focus on and invest in deep technology, retail, and fintech within the pre-seed and seed rounds. Overall, our footprint and numbers, this month we'll have done over 100 shows, up to 100,000 monthly social impressions. We see over 300 companies a month. We've got a podcast where we interview angels and global VCs. And we've invested just under 2 million over the better part of 3 years through our fund. And we've had 2 exits. One of them is an RTO. So our main program that we work with and push out, which is pretty exciting on our end, is that we take 10 companies through the funnel that we work with, and we work with them through consultation or coaching, build data rooms, and we have them pitch in multiple events, which some of this is somewhat altered over time. And through those pitches, which you can see here on May 19th and 20th, they'll do 5 and 5. From there, they rate and rank and review those companies. And the top 8 companies will move forward and pitch at the final event. And with that, we have a 7-minute pitch, 10 minutes of Q&A from a global panel of 8, 3 Canadian and 5 global screening investors, with over 50 global investors that join the event to pick up the deal flow that fits best for them. Some of our other exciting events that we talk to and that we love to put on, ETE, which is Entrepreneur to Entrepreneur. The last one we ran was 7 countries, 14 pitches, 2 minutes each, and in front of all of our accelerators and incubators where they're pulling deal flow. We put together a panel conference, and inside of this panel conference, we decided to just do a little panel that was going to be on esports due to our interest and investment into esports. And we made a couple of posts, and just shy of 30,000 interactions, we decided that we should turn this into more of a mini conference and create some great content to get in front of investors and in front of some new startups. So from that, we work with and have made some great investments into some pretty amazing companies. And we're pretty excited that we're part of this ecosystem. And as we continue to grow across Canada and across the world, we're excited that we have a fund and that we're able to continue to invest. And just high level, we are originators of content, which is originators of the startups that we bring to market. And then from there, we continue to be first money in. And that's what's really allowed us in our both funds to stand out in the market for what we like to do. And we're currently just closing up our fund 2, which is currently at a 25K investment that'll be reassessed May 1st. We'll be starting our 3rd fund, which will be a $10 million round, and we'll be putting in larger investments into these pre-seed and seed round companies. And as I mentioned, our whole driver is that we want to be first money in and that we originate the startups. So open to any more questions you may have, Laura, or to the audience, but thank you again for listening to and walking through what we do, but what there is a huge opportunity to be looked at and investigated into the early stage investment class.
Perfect. Well, that seemed to go very well. And open to take any questions from the audience. You can raise your hand to ask a question, or you can post it in chat, and I can certainly jump on those. And again, thank you everybody for joining us today. Laura, do you have any remaining questions?
No, I think we covered them when we did it.
Okay. Laura, maybe you can share in the chat the event that we have today. For the event that we have at 2 o'clock.
Sure, I'll add that.
Okay. For one of the questions that came up from Jaspel Singh, can you tell me more about Fund 2? Also, what is the IRR for the fund? So Fund 2, and just give me a second, I will share this on the screen. So for Fund 2, currently right now, it does close at tomorrow, but because of the date that we're doing this today, if anybody is interested to jump on a call or have more insights on the fund, we'll be more than happy to have this conversation shortly, meaning we can book some time later this week or early next week to discuss further on the fund. We'll leave it open for the people that are on here today to have those discussions. But on Fund 2, we're currently closing it off at the end of the week. It then goes into a reassessment as we've been making investments for the last year and a half in the companies that we've had made investments in. You can see here that we have multiple companies that we've made investments. We're first money in, and we've also originate the content by bringing them to market. So if you have an interest to have a further discussion, more than open to do that. On May 1st, we reassess the value of Fund 1, Fund 2, and then we introduce Fund 3. And Fund 2 will be reassessed on the unit value. The origination unit value is 25K. When we reassess the value of the fund over the last year and a half, we're looking at anywhere between a 35 to 50K value, increased value in the fund based off of the investments that we've made to date and the growth of those companies. The next question is how does negotiation of terms and conditions of the investment actually happen? Is there very standardized, or is there negotiations that take place? Thank you for the question. It is actually, they are negotiated. Because we do first money in, we tend to be working with the startups and the companies. They do come to us. As we mentioned, we see 300 companies a month, but we net those down. And when we look at the smaller subset of the companies that we look at, we then do go into negotiations with them. When you're origination and coming into being the first money in, you do have the opportunity to work with them and putting together the best value before we bring them to market. When we do bring them to market, we tend to bring them into our Skip the Line program. And when we bring them to this program, it could be anywhere from 3 months to a year after we've made an investment. It really depends on the trajectory of the business and where we're trying to bring them. And then we do get into negotiations with that first investment on where we see the best fit for the dollars that we be bringing in. We tend to, and we'll continue to follow on this in our third fund as well, where we put in 100,000 as first money in, and then we'll invest up to 350 on the next substantial rounds. And again, we do this as a way to build a value into the business while bringing them to market and helping them raise on their next rounds, which leads to a stronger success point and allowing our investors to work inside their businesses on board seats or in director roles. Again, we work with the companies to ensure that these occur and that these are ways to help them win. And we want to make sure the value is there across the board from the first investment all the way through until they get picked up for their Series A and raises above. We do. So you again, a great question on the panel, on the chat. So our structure, your typical investment in an early stage pre-seed and seed round investing, you have an IRR of 18 to 22%. We currently do fit in that because we are only 3 years old with our launching our third fund. We do see that there is a potential shift in that so that we can increase that value so that it would be a better position from an 18 to 22%, but perhaps getting that more into on the higher end of the 22%. When we look at that based on the relationships that we're building, the deal flow and the opportunities of being able to pick within the larger section of that startup community, Because we do have global access, allows us to look at companies globally. Currently, Fund 1 and Fund 2 are Canadian based, and then Fund 3 will be North American based, and we're just setting up that structure currently. So from a long-term and short-term plans, when we do look at the investment opportunities, what we do look at is what in the areas that our fund invests in deep tech, retail, and fintech. We do have committee leads that help us really dive into these sections and sectors of business. And with that, deep tech tends to have a longer exit period, whereas CPG is more midterm, which is 5 to 7. And in the fintech space, they tend to have a shorter execution. And reason being is that if they are in the right spot, doing the right things, a lot of fintech companies will get picked up because money will create more value quicker, and they want to bring them in to expand that product level. Sorry, I'm just going through each one of these questions. So hopefully that answered your short and long-term plan and our strategy. I'm not sure I understand, can we fundraise in active investment strategy? Maybe you can clarify that question a little bit more for me. That would be much appreciated. How do you look at investing in an idea that is under development? I mean, a startup that is working on a product, but is yet to be launched. Great question. So when we look at, we do work with lots of companies at all different realms of the cycle of where they're coming in. Could be from an ideation stage all the way through. We tend to push those ideation periods that the companies would go and speak with accelerators, incubators, and get into their realms. We have partners like Founders Institute, Seneca College, and the other York Y Space, and all of these have great accelerators and incubators tied into them. So if it is really, really early stage, we'll go through the pitch with them, make some recommendations and some comments to share to help them along. But we really do push them into getting further into an accelerator to help them pull out those ideas and turn them into an MVP. If it's a deep tech space, we do help on that side from a deep tech perspective. If we feel that it's a good fit and a good product, we can help them with that build. But assessing these companies at an early stage is really just understanding a lot of the different markets and the way they're working and figuring out where we see this company fitting, and then diving into the other metrics that we use to analyze companies. And from that, when you're analyzing them, you can then decide if there's a bigger opportunity for an investment. And as you can see here from our funnel and how we work with startups, we do go through a pretty extensive review. And while going through that, we can pull out where we see the opportunity from a marketing execution. And of course, is this something that can land and expand across Canada, but then across other countries? So scaling is a pretty big one. And it all falls back to the startup and the founder and the team. So lots of different things that we can pull in from that aspect. To go back to the Q&A, is it a 100K investment per company at the first stage? How much approximately is the equity acquired in the company? Correct. If we're going in as first money in, it's not always 100K. We do target going in at 100K. If we really do like the company, we want to make a commitment. We want to be with them through their growth. So we will make a $100,000 investment. In the last company that we went in at, or in companies in that space, we try to look at valuations between anywhere between 1 to 10 million on a valuation. Some companies will be pre-revenue, which means they haven't started to make revenue, but they do have a live platform. They do have users or people using the platform, or they're working through that. If we do make an investment, again, it's a pretty good chance that we'll try to make that $100,000 first money in. And the valuation of the companies tend to be anywhere in that early stage, again, anywhere between 1 to 10 million. If we do come in at 100,000, let's just say for a $2 million round, we would be first money in. We would push them to then raise maybe their next round at 5 million, as we want to make sure that the startups maintain as much of their equity as possible, so that they're not diluting themselves too early on. And at a 2 million valuation, that would be 5% of the company. And then we'll continue to raise or invest in them throughout their journey up to a Series A. So active investment strategies like trading, Forex trading, stock trading. So currently, because the way we're structured as a fund, we invest in the early stage pre-seed and seed up to Series A investing. We don't tend to go any further than that. Now, we do have a company that we invested into our Fund 1, who is now going on the public markets. They will be launching on the TSX in May, June. And with that, they would then be a publicly traded company. It then becomes part of our mandate to decide if we would take an exit at the time of the launch and be paid out and then offer those dollars back to the investors that are in the fund, or if we choose to leave it in the public markets and manage it just as we would any of the other companies that we're investing in. That is actually the only way that you would get into stock trading or Forex trading with the current structure of the fund, Fund 1, 2, 3, and soon to be the 4th fund. We wouldn't, at this point, we would not be doing that, but that doesn't mean that in Fund 4, because we do have a debt product that would be launching, that we wouldn't start to look at other opportunities that we could see from a potential conversion of dollars to benefit the investors that we work with. But at this point, the mandate is that we just invest only in pre-seed and seed round companies. For Fund 3, is there a pre-established target the fund wants to reach between deep tech, retail, and fintech? There is. Another great question. And I will show that screen. So inside of Fund 3, we'll be doing 40% will be into deep tech, 40% will be retail, and 20% fintech. We will be, this is kind of the targets. It doesn't mean that it's 100% set in stone, but it just seems that most of our investments fall into these areas. And we do have the most success in the companies that are in this range. And this can change based off of different investors that join us. But at the same time, this is the buckets of how we look at our Fund 3 investments. I think that's pretty. Nunzio, great to see you. We'll certainly catch up. Very excited to have you here today. And outside that, I think we pretty much were able to answer all of the open questions that I see here. If there's any other questions, please feel free to share them in the chat. I'm also going to share my email address. And everyone, you're more than welcome to email myself or Laura. And we'll be happy to book time, especially due to the crunch time that our Fund 2 closes at the end of this month. But we are going to extend it, of course, just for this group. And until then, feel free to reach out. How can I raise the funds for Forex trading? Well, I think we can take that one off to the side and have that discussion. I'm sure that there's an opportunity and we can figure out how that will look, but I'd be happy to book some time to have that conversation. A great question. Do we look for large growth first or profits first? Because we're first money in and the companies tend to be really early stage, they may be pre-revenue, so they probably have not actually started making any revenue, or at least small MRR or ARR, which is your monthly recurring revenue, or annual recurring revenue could be quite small. So we have companies that are doing, $2,000 a month, but we look at the potential growth and upside. Oh, sorry, I think I sent it. Let me do that again. So we look at the companies at different stages of the investment cycle. And when we do make that investment, again, we have lots of different criteria, but we have to look at it from scalability. What are the opportunities that this company can go across Canada, North America, globally, so that they can drive out larger dollars, which will then allow for larger VCs to come in. And we work on all of those fronts to ensure that not only do we support our startup companies from beginning, pre-seed, seed up to Series A, but then we do have follow-on investors that take our investments that fit into their criteria. So we help those startups sell into these other VCs. So we do have to align well in the community, just so that we can ensure that we've got the great positioning of our startups moving forward. And from that, we do have companies going to Series A raise, again, public markets that have gone to that. And we continue to work, and we look for great people that want to come in and be part of that. And I guess just a side note, Ian, to your question about profit, most companies don't tend to be profitable for a few years, especially if they're looking to raise funds. So it's always good to keep that target in front of you, that you're planning and shooting for profitability. But the great thing is that having that target in front of you allows for you to continue to take risks, to grow, because at the end of the day, investors are looking for quick, high growth companies. So in this case, you're always looking at maybe it's 8 to 12 months out from being profitable, but that number continues to grow or double in time based on the dollars that you bring in to grow quicker. So everybody wants to be able to add in growth capital, which allows you to move quicker through the space that you're selling into. And then all the dollars you bring in will continue to push out your profitability date. But what it'll do is increase your bottom line and top line revenues, which is going to be super helpful in you growing that company. And that's what investors are looking for, is that if they do an infusion of $1 million, $2 million, $5 million, that's going to help you really grow your business. And then you'll start to get into further on in that Series A. You're then getting into operational dollars and so on to now support and get your company to be more of a profit center at some point in time. But really, the dollars are always driving your business to grow. Again, thank you very much, everybody, for joining today. This is our third Lunch and Learn, and we appreciate that we're able to get in front of all of you and share the story, share what we've been up to, what we've done over the better part of the last 5 years, and how we've really dived into this early stage ecosystem after spending a lot of my years working in it from the side to being in it full time. But happy to share any other questions, comments, background, or anything that you're looking for to help you navigate through the early stage investments segment. And if I can answer any questions, by all means, please send an email, and I'd be more than happy to book some time and chat with you. And again, I appreciate everybody's time. And if you can join us in 4 minutes, we'll be doing our global E2E. And I think Laura mentioned that, posted the link above. There'll be 20 companies pitching today and 8 countries. So that's pretty amazing. So pretty exciting. And we do pull companies from here as well, just as our other partners that join in. It's 2-minute pitches, really a lot of fun. And it's great to be able to interact globally with all of these companies. So it's certainly worth checking out, and look forward to chatting with you more. Feel free to also, I'll post just quickly my LinkedIn, if you would like to add me there, and we'll follow up with an email as well to chat with you guys further. Thank you again for joining us, and looking forward to continued conversations.